Good evening, everyone. Bill Ulivari here with Senecal Capital Management. Happy New Year. Thank you for joining me, and I'm just going to take a few moments of your time to go over one incredibly profound chart, something that happened at the end of 2022 and I was just notified of it recently in 2023, January 9th today at 5:24 p.m. And I'm going to share my chart with you because I think it's so incredibly important that you see this. But just give me 1 second here to get my screen shared. So this one chart I want to share with you, I think is one of the most important charts of the next few years. And I'll tell you why. This chart is just not of any one stock or any one bond. It is a chart of relationships. Emerging markets versus our technology indexes, the QQQ NASDAQ 100, one of the most popular liquid exchange traded funds known to man that's traded here in the United States. The top 100 companies like Facebook, Amazon, Tesla, and the list goes on and on. The top 100 technology companies in the United States versus emerging markets. And while this is really important, is that what we do is we take emerging markets, divide it by the NASDAQ 100, and multiply that number by 100. So again, we're talking about relationships here. It could be just as easily Walter Payton versus Michael Jordan. It could be the Chicago Bears versus the Green Bay Packers. Like any two products that you want to compare to each other is called normalizing. One simple way of normalizing is divide one by another and multiply it by 100 in order to find like a common rule. Okay, so what happened? Dot-com bubble burst in 2000. The market sold off until about 2003 when we put in our lows and we began railing really well. But what people didn't really recognize was here in the 01, 02 area, emerging markets really took off. And honestly, I'm almost profoundly shocked at this chart because I would guess I was so focused on technology and I was still on the trading floor at that time that I wasn't really paying attention to emerging markets because it wasn't in my viewer. But here, from 2001, end of 2000, 2001 until 2008, the Great Recession, emerging markets were up 270% versus our markets being up 20, right? The S&P 500, I think, was up 18 or 20. NASDAQ QQQ was up maybe 40% over those few years. Not a bad return, but emerging markets absolutely kicked the covers off the table in terms of its performance with respect to the US. And similarly, what we saw here in the peak of 2010, when interest rates began to decline and the Federal Reserve flooded our markets with liquidity, we saw the opposite happen in the emerging market countries. So the United States took off. So when the denominator gets bigger versus the numerator, the number gets smaller. So this is here as emerging markets being better and performing better than the NASDAQ. And this is a little like shifting gear, like a little pause. And then our markets absolutely destroying emerging markets. In the same time period, from say 2010 until December of 2022, January of 2023, our markets were up 450%. Emerging markets was down 7%. 450% return for us, down 7% in emerging markets. And why is this important to you, you say? Because look at this. For the first time in 13 years, we got a first green buy signal in emerging markets with respect to our markets. This is a huge, huge shift in money. And I don't want to call it a transfer of wealth, but I'll certainly say it's a transfer of opportunity. I still think our markets are going to do well. I think interest rates have peaked, and we're going to recover from the down 20% S&P market and down 40 basically in the NASDAQ 100. I don't think we're going to go through that same thing that we went through when the dot-com bubble burst in 2000 to 2001, where the QQQ NASDAQ was down like 70% from peak to trough. I don't think that's going to happen here. I think the damage is done. But what I do think is that while our markets are still struggling to recover, and I think they're going to do okay, I think emerging markets is the place to be. And so we're going to be shifting your portfolio out of domestic technology products and a little bit of the S&P 500 and move 10, 15, 20% of that to emerging markets because now is the time. The time is right. What is emerging markets? You are probably asking yourself. Emerging markets are countries like Hong Kong, South Korea, Brazil, South Africa, Russia, Mexico, Indonesia, Poland, Philippines, Kuwait, Thailand, Saudi Arabia, China, India, Greece, Hungary, Egypt, and other countries. Japan, even in some respects, is considered emerging markets, depending on how you look at it, because their markets really haven't gone anywhere in 20 years, 30 years. So anyhow, I just wanted to give you a heads up, because we're going to really be leaning into emerging markets for your portfolio. This is the reason why you pay us our management fee, is to identify long-term trends like this that we can take advantage of for your retirement accounts, for your investment accounts, and to help you grow your wealth. So again, this is not like a light switch. I don't have to do this today. I'm just saying that keep in mind that while we hear on the radio and we see on the news that Europe is dead, emerging markets is dead, at least that's what I hear from my side. The truth is, it's not true. I think the truth is, I don't know why it's going to happen. I just know that it is happening. This is data. These are metrics. These are thousands of funds that are being compared one to another, especially the emerging markets versus the NASDAQ 100. And we're going to do similar studies and similar videos like this, comparing emerging markets with the S&P 500 and Russell 2000. So while we still think there's some great opportunities available, we think emerging markets is the place to be. And then lastly, what I wanted to do is just discuss the opportunity of cash management. We've been received a few phone calls and emails from our clients looking for places to put money, but still want to have liquidity and have access to it. Well, we put together a exchange traded fund portfolio of about 5 companies, 5 ETFs. And those ETFs are paying around 5.5%. Short-term corporate bond funds, also high yield corporate bond funds, paying about 5.5%. So if you guys have an interest in parking some money, not in a checking account, but in a regular trading account, and earning about 5.5% in dividend stream, please contact our offices at 847-686-4800. And for those who are our clients, you already have been notified that we have a text messaging app that you can contact us at night or day, right? It's our FINRA approved messaging app. So either send us a text message and say, hey, Bill, I want to know more about the cash management program, or, which again, this is better than a certificate of deposit, in my opinion, because there's no penalties, there's a lot of liquidity, and it still pays a great rate of return. And again, thank you for being a trusted client. Thank you for being an amazing investor. And thank you for being a part of what we're trying to bring here to Senecal Capital Management. And that is these ideas outside the box that can have a profoundly good influence on your portfolios. Thank you again. If you have any questions, don't hesitate to contact us, 847-686-4800. And please feel free to share this video with a family member or a friend, someone who's confused about the markets, or maybe their investment advisor is not doing videos like this. You have 100% access to me, either via text messaging or through a simple phone call. Thank you so much and have a great day.